I do believe that the euro's headed lower. We've got this yield chart that we've been looking at between the two-year spread between Eurozone, German, and U.S. yields, and that's screaming for a lower euro. There's a lot of risks in 2016 that the euro faces. One of the ones people may be interested in is that the euro tends to perform terribly during an election year. We looked at the last 10 election years.
In the euro.
Yeah, in the U.S. And we looked at the last 10 election years, and the euro dollar actually fell 8 out of those 10 years. And one of them was pretty much an unchanged performance where it actually increased. So I think this year could be another weak year for the euro. We all talk about the risk that the Eurozone faces between Russia, ISIS, slower growth. And you add to the fact that we've got more hawks in the birdcage for the Fed in 2016. There's a very good chance we could see 105 tested, but parity, I think, is a far-fetched target.
Yeah, 105 is bounced off there 3 or 4 times. Ed thinks that the clearing rate for rates isn't much higher than we are right now. And I would think if the market started believing Ed, that would be bearish for the dollar.
I think the key to the dollar-euro this year is what does the Fed actually do? And if you go back and look at this year, of course, the dollar basically peaked in March, and we've been moving sideways to slightly weaker since then. And I think is the expectations that the Fed was not going to be as aggressive as people maybe thought back in the spring. That's changed the dynamics. Now, as you go into this year, the Fed has already started to raise. The question is, how many times are they going to raise? And if you look on a purchasing power parity basis, it allows you short-term forecasting tool, I grant you. But on a long-term basis, the dollar looks a little expensive. So I think really this year in currencies, in my mind, comes down to what does the Fed actually do? And I think they're going to actually be less aggressive than the market expects.
Well, I hate to say it, but purchasing power parity is something that the market doesn't really pay much attention to, even on a 1-year, 2-year basis, which I wouldn't necessarily consider short-term. I agree with you that the Fed may not be as aggressive as the market expects, but I think that's their rate hikes will probably be more front-loaded than back-loaded. So I'm looking for U.S. dollar strength in the first half of the year. Then they're going to start to feel the pain of the rate hikes. And when they do, you're going to start to see them slow down in the second half of the year. So that's why I think 105, which is only about 3 to 4 cents away from current levels, is not a far-fetched target. And that can happen. We could still be at back at 110 by year end. So I think we're going to see a 2-phase movement in the FX markets in 2016.
So you scared me a little, Kathy, because normally we don't try to factor in exogenous terrorist type activities and you say, well, if that happens, then all bets are off. Then why even talk about it? But there's a chance Europe is much less prepared and much more vulnerable than we are. And I would think that if you're a currency trader, there's no way that you can ignore that, and that could hurt the euro, couldn't it? If it was happening more frequently, and they're thwarting terrorist attacks almost every day in major cities over there, and you've got refugees, and I mean, what would that do? I mean, the economy then weakens because people don't want to go out, and it just hurts the euro the same day that it happens, too, right?
You're absolutely right. It's a risk that it's the world that we live in right now, and it's a risk that euro-dollar traders can't ignore. I hate to say it, but ISIS is embedding terrorists in the refugees, and so as a result, there's a very good chance that we could, if the governments are successful, see another terrorist attack in 2016. So I think one way or the other, between the broad perspective of Eurozone growth, as well as all of these other risks and realistic geopolitical risks and possible Russia showdown, we could actually see the euro feel some exogenous shocks lower in 2016.